welcome to Mokama Sunday service. This video is for informational purposes only. I am not a licensed investment professional. Investments trading is risky, so do so at your own peril. Refer to your financial professionals and advisors regarding any and all of your intended trades and positions. And with that, we'll get started. The top 5 reasons to exit a trade, inspired by you. So
Appreciate
the first question that I always ask myself is this an investment or a trade? This is what I just asked you, right? Are you going to start investing or trading first? Investing is long term, trading is short term. The reason why I say this, and I think this is important before we get into the top 5 reasons, is because I'm going to treat my investments a lot different than I treat my trades. Trades are more short term, right? If I'm day trading, I might be in a trade for 30 minutes to the end of the day, right? Typically, sometimes less than that. If I'm swing trading, I might be in a trade for a few days up to a couple of weeks, right? And then typically, if I'm long-term investing, this is something that I want to hold for at least a year, ideally. And if not 5 to 10 years, right? Which is my ideal investment period, is 5 to 10 years. So am I investing or am I trading? My rules for exiting an investment are probably going to be a little bit different than my rules for exiting a trade. And that's because if I'm typically investing, I'm never buying anything at an all-time high or near an all-time high when I'm investing. When I'm trading, that may not be true. I might grab it on a pullback after an all-time high because I don't intend to hold it for more than a day or a couple of weeks, right? So, are you investing or are you trading? My standard investment parameters, I'm generally not buying anything that's not going to be close to its 200-day exponential moving average or at least 50% off from like a fib level standpoint. So I'm going to give my investments a longer time and probably a little bit more wiggle to work than I am going to be for my trades because generally, if I'm buying something for an investment, it's going to be at a relative low point. The first reason why I would exit a trade, my thesis is no longer correct. So you got to ask yourself, why did you enter this trade in the first place? And is that still correct? Okay, so I did buy a leap, and I wouldn't, this is a trade, but it's a long swing because it's a leap. It's in my retirement account. So I treat it more like an investment than a trade because it's something I intend to potentially hold for over a year. But look at Disney. I think I bought Disney on one of these days, right? When I was telling you guys in the chat. It looked like it was giving really good support around this 200-day exponential moving average. Then it popped up and then it kind of came back down to the area where I purchased this leap, an option. So when I when I purchased the leap, when I bought the leap in Disney, my thesis was that hey, if this can hold above 100, you'll see I have an alert right here that's already on my chart marked at 100. If this can hold 100, I think this is a good place for Disney to pop. It's also around the 200-day moving average. If it can get up above 100, stay above 100, and stay above that 200 moving average, then this is still a trade that I want to hold, even though I bought it on one of these days and it's hovering around that same area. It went up and then came back. I didn't sell it yet. I'm still holding it because my thesis is generally stocks like to bounce off these nice round whole numbers, like 100 would be perfect. So as long as it stays above 100, I'm okay with holding this and letting it wiggle whether I lose a couple $100 or not, right? Because my initial thesis was, hey, this is a good risk reward because I know stocks tend to bounce off their 200. Disney has kind of had a history of getting some movement or a bounce off its 200, right? So, since that is the case, like I am going to be comfortable. Um, I'm going to be comfortable holding this until it gets below this mark. If it gets below this mark, I'm going to be a little bit anxious. And then if really, I think my final stop, like I'm really going to be watching it if it gets below 100, and if it gets below 99.27, which is a level I believe I've drawn based upon like a weekly chart or something like that, then it's going to be time for me to just eat my loss and then wait for Disney to drop a little bit lower, right? And then maybe pick it back up later or go use my capital to buy something else, right? So if my thesis is no longer correct, that's the first reason why I might exit a trade. Okay. Does that make sense to you, Trey? I can't hear you.
Yeah, yeah, it makes sense.
Right.
So
Why did you enter in the
if
short
the
term?
numbers matter. So bottom line is what your original thesis was as far as how the trade should go. It's going left as opposed to right. You're gonna say, all right, let me go and get out of this.
Yes. And so for me, it's like if Disney got close to 100, and look at here, this candle right here, I'm looking at that as like a floor almost. I don't want to see it get below this candle right here, which was the floor it established on May 23rd. That was the most recent low. I don't want to see lower lows. I want to see something like this. Maybe it comes down again and then bounces up. That's what I want to see. And my thesis is that it came from a high of 123 all the way back down to 100, which is almost like a 20% drop. And so if the stock market in total, the S&P 500 drops 20%, everyone would be panicking right now. So the fact that we got this huge drop, I think it's exhausted. I think most of the people that wanted to sell, they sold here, they sold here, and I think we got a lot of long-term holders that just want to hold Disney forever at about this level. That's my thesis. So if we drop below this candle or drop below 100 and we keep kind of going, my thesis is wrong, right? So if my thesis is wrong, I'm not going to be one of these guys that holds on for forever until it gets down to 50 and be like, it's eventually going to come up. I will just eat the $200, $300 loss and move on to the next trade, move on to the next investment, instead of waiting a year for Disney to climb back up, you know? So you just got to know going in. I knew going in, I bought this, I think, when it was around 102, that I was going to give it to around $99. So that's a $3 risk. So for each option for me, that's about a $300 risk. And then all my reward is 102 to around 123, which is what, 20 bucks or so. So
That makes sense. So
I'm,
you and so mainly what I'm understanding is take the emotion out of it. If you're wrong, you're wrong, and know how to learn how to get out.
yep, trade like a robot if you can, you know. And so just going to my Apple trade. This is the one that went really well, right? I bought it on this day right here because it was a decent percentage off. I bought this leap on this day, right? It came up, and what did I say at the time? If I bought it at around 166.5, 167, I said if it gets to underneath 164, I'm going to sell it. It didn't. It popped up at 164.08, which means I picked an amazing stop loss, right? It was right there. It popped up off 164.08 and never came back. pulled back a little bit here, came up. Same thing. I told myself, hey, if I'm willing to risk $3 because I think Apple is going to bounce off of this fib level right here that I had drawn on my chart for months. So I was like, you know what? This is a good time to enter because it's an edge, right? So there's limited risk. If it popped below 164, I think I had to stop at like, I don't like to keep it right at round numbers. So I think I had it at like 163, like 80 or something like that was probably my stop. And it bounced to 20, 30 cents above that and just kept going. Right. So that was going to be when I would have exited the trade. If it would have popped down another 30 cents, I would have just got out of the trade because my thesis was incorrect. It didn't bounce off 166. But in this case, it did bounce off 166. So my thesis was correct. So I stayed in the trade. Your second question was, when should you stay in a trade? It's very similar to the same reasons why you would exit a trade. So if your thesis is still correct, stay in the trade. If your thesis is incorrect, get out of the trade, right? All right, so let's go back to reason number two, a percentage loss stop. So do you have a defined percentage loss for your particular trade? And how much can you personally stomach? This is something else we were talking about at the beginning, DeAndre. People have different risk tolerances. There are some people that are willing to risk 40% on every trade. There are some people that are willing to risk 50% on every trade. There are some people that are willing to go to zero on their options trades because
50% to 0%. Are you kidding me?
yes, it depends on. So some people are home run hitters. They know that they're going to lose 80% of their trades, but they know they're going to have a home run. And the home run is going to pay for all of those 80%, right? That might be your strategy. Some people like hitting a bunch of singles, right? So those are the people that are going to have 10% stop losses, 5%, or trying to move the break even almost immediately if the option or the stock goes in their way in their position. They're looking for quick moves to one side or the other, or they're out, right? So it really just depends on your strategy and how much you can personally stomach. If you're a home run hitter and you lose 70% of your trades, but the 30% are major winners, then, you might be willing to go to zero on some of your options. That's not how I trade, but if that's your strategy, like that's your strategy. And usually risk takers, they lose a lot, but they also make a lot too. So it just depends on what your edge is. Do you have an edge? And then how much can you personally stomach? On my options trades, I'm typically, I have a stop loss from 15 to 25% depending on what's happening. And that's on a trade basis. Like generally my stop is going to be 25%. I widened it from I used to trade with 20% stops. Now it's 25%. The only time I'll probably push that up to 15% is if I see something like not setting up really well. Like I enter a trade and then I just see the chart doesn't look like it's doing well, or one of the indexes that I was pairing with that chart is starting to fall. And if that stock is heavily weighted in that index, then I know it's probably going to fall with it. So I might tighten my stop up to 15%. Um, but that's for me personally. But I generally trade with the 25% stop loss before I cut a position, specifically when I'm trading options. So that's my defined percentage loss. So specifically with trading, where I am getting in at a position where a stock may be close to an all-time high off a pullback, I'm probably trading with the percentage loss. And as soon as I hit my percentage loss, I might give it a couple of cents if we're talking options, and to see if it's going to bounce, or look at the chart to see if it's hitting a minor low. And then if it doesn't, it looks like it's going to keep going down, I'll just cut it and take my 25% loss and then move on to another trade, so that I could preserve my capital. So ideally that I never blow up an account on a trade that goes bad, or I don't want something that I thought was a trade to turn into an investment because it's gone down so much that I can't sell it at where it is. So once I hit my 25% stop loss, I'm out. Sometimes if you're holding positions overnight, you're going to get a greater stop loss than the one that you anticipated because of gaps up or down. And those you can't really help. Like if there's some bad news that hits overnight and you can't trade out of your position because you're trading options that are only open during the market, then you're going to be screwed sometimes when the market opens or closes. Like especially like the first day or two that you enter a trade, where you didn't really have enough time to kind of like take profit or anything like that. So percentage loss is the second way that I might exit a trade. Once I lose a certain percentage, I'm done. Third reason why I might exit my position, I hit a target. This is a good reason for exiting. And I would also say don't be greedy, right? What did you initially intend to get out of this trade? And did it hit your target one or your target two? Don't be greedy and go, you know what, I'm going to hold my whole position because it hit my target. Or like you need to pay yourself when you can, right? Rather than on the way down. It's a lot easier to get out on the way up than it is on the way down, depending on if you're buying calls or puts, right? But it's a lot easier to get out when things are going in your direction. So, what was your target? And for me, I don't trade anything unless I have a trigger, a stop, and a target, if not multiple targets, right? And usually it's multiple targets the way that I trade now. I usually trade at least two contracts of something, if not 4 to 10, depending on how much the option costs, so that I can have multiple targets, right? That Apple trade that I took, I had two contracts. Can you see my screen? Can you see Thinkorswim?
Yeah, I see it.
Right. So when I took that Apple trade down here, the leap, I took two contracts and my IRA and my wife's IRA. Right. So I had four contracts in terms of all my positions on Apple. So, so I took it right down here on this day and I had two contracts in each account. The reason why I took two contracts is because my first target was around the middle of this zone, right? 166, the middle all the way up to around 199. The middle was around 183 and 50. I think I sold it on this day right here. Yeah, that was the event day. I sold it on the pop. I sold it, I think, right around 184 on this day. So I sold half of my position and made 1,500 bucks on that option from 164 to around 184. And I kept the other one as a runner. But on that same day that I sold that option, because I hit my target one, which was like the middle of the zone, I kept a runner, but then I put a stop loss on that runner at break even, which is around where I bought it. So my worst case scenario was that I made $1,500 on one option and that the second contract I'm playing with house money and I'm just gonna let it run. Even if it would have dropped all the way down here, I just would have kept it, you know. And because I'm playing with house money. And my thesis, what we talked about earlier, was still correct that Apple was gonna bounce off 166. So I sold my first half of my position in both accounts right there. And then I had a target. I've been telling you guys for months that my target was around 197, right? Right before its all-time high of 199. I wanted to get out before it hit an all-time high because in the past, when it's hit that all-time high, what has it done? It's bounced back down. So I wanted to get out before 199. So I sold my remaining position for close to 197 in terms of that price range because I think it didn't hit it, but it hit the high was 196.94. So I bounced right down off 197. I got out right there with my last remaining option, and my total win on both of those and both of those accounts was 4,000 a piece. So I made like $8,000 off that trade, right? And this is my thesis again, right? So this was a mix of my target being hit and my thesis being that if Apple gets back to an all-time high, there's probably going to be a lot of selling here. So I want to get out before everyone else sells. So I got out of my Apple position.
And how long did you hold on to that for?
I bought it on April 19th. So what are we? A month and a half?
And this is for your investing that you're
This was for my leap. I intended it. I just didn't think Apple was gonna go. I didn't think Apple was gonna go up that fast. It just did. So I hit my target. Even in my investment account, my thesis on the invest, like I would rather. Let me go to a different view. Looking at my fib levels, I would rather buy Apple if it gets to 121, right? 50%. Because that's when I usually like to buy an investment when it's 50% off, right? Do I think Apple's ever going to get there again? Shit, I don't know. Probably not. You know, Apple could keep going if you look at its history. So for me, this was a little bit aggressive, but look at this range, right? So when I saw it hit the bottom of this range on this day, like I started salivating. Apple hit the bottom of this range. It popped up right there. It popped up right there. And then I caught it on the exact day that it hit that range again. And I caught the edge. And I sold at the top of the edge. Yes, Apple might keep going and hit an all-time high, and I could have got out too early, but I'm not going to be greedy. I got my chunk that I wanted, right? That was my original plan when I told you what my risk to reward was. I was going to risk $3 to make this, you know, what's that? $30. So it's a 10-to-1 risk reward ratio. I bought it at like 167, 166.50. My stop was at 163 something, high 163s, and I wanted my target. My first target was at 183, 184, and my second target was at 197. Mission accomplished. Now it's time to go on another mission. But I will put an alarm again right here at 167. If Apple ever drops back down there again, what do you think I'm gonna do?
yeah, of course.
Same coin.
I'm gonna buy it again. It's in a range, right? It's in this range. It did that once, twice. So if it gets down there again, I'm gonna buy it again at 166, and then swing it back up to 197, and then sell it again. It's just patience. It might take a month or two to get down there. That's fine. You know, just set an alarm. So for me, my target, number 3, if my targets get hit, that's when I'll get out. I'm not going to be greedy. I got my chunk in Apple and it's at an all-time high. I don't want to buy anything at an all-time high. So I got out. Yes, it could keep going up. Yes, it could explode. But man, I got my $8,000. I got my chunk out of it, right? And I'm waiting for it to pull back again. I would love it if it pulled back down here or here, but there's gonna need to be some really bad news or earnings reports for Apple to get back down here. But it's at all-time high, so I'm done. You know, I'm done. I move on, and then I don't feel like I lost out on Apple's move. I got the entire move here, right? So don't be greedy. Like I waited, but I also the reason why I was able to stomach and like Isaac, you got out of the trade a little early. The reason why I was able to stomach that is because when it got to that halfway point, I sold half of my position. So I locked in some profit. Locked in some profit at target one. Then once you're playing with house money, you can risk more, right? Because it's house money. I already won. I already won $1,500 in each account and I got a stop loss at break even back down here. So like I don't even have to watch this anymore, you know, and I can watch it every now and then and wait for it to like pull up. And then if it's getting close to my target, I had a, I had an alert on at 190 or getting close to 5 cents before 197 or 10 cents before it triggered and said, hey, it's there. And I sold my position and got out. So reason number four, why I would exit a position, time based, right? Do you have a time based exit? Is there a volatile event coming soon? What do I mean by volatile event? Earnings. If you look at last Friday, non-farm payrolls pushed the market. Um, so especially if you're trading options, if you got earnings coming up, dividend date, uh, inflation numbers, the Fed is speaking, some of the stuff that we talked about last week in terms of like things that could really push the market one way or another, then you might want to exit the day before that happens or the hour before that happens, whenever it's going to occur. So, time based exits. So, let me go back. I want to show you what effect like non farm payrolls had on the market. It was reported, I think, at when was non farm payrolls? Stock market catalyst. This is how I look at what's going to affect the market this week or next week or last week, right? So if you look at the last week, non farm payrolls came out at 5:30. So it was pre market, right? So let's go back to Thinkorswim and go find 5:30 on the S&P futures, which is what I watch because it's open almost 24 hours a day. So if we go to, where are we? Friday. Look at what non-farm payrolls did to the S&P 500. You guys see that?
Yeah.
Look at that bar. So
Oh,
imagine if you were holding a position from Thursday into Friday, and then a number gets released about jobs numbers, and it tanks the market, right? So that's what the ES looked like. Look, and that's right at 5:30. So that tells you that's exactly when the payroll numbers were released. So even if my position is going well for me, especially on a shorter term trade, if I see a big event coming up, like non-farm payrolls, I might exit that position on Thursday anyway, just because you never know what's going to happen. Does that make sense though?
no, that makes perfect sense. That's a huge nosedive.
Look at NQ. That's the NASDAQ. Same thing. 5:30. We're on the dot. The Dow. Same thing. 5:30 on the dot. Huge drop.
So when will you know when these reports are coming out, though?
Well, that's why I tell you guys when we come on Sunday, I usually go look at this. To go look at what's coming up this week. I go to Market Watch.
And look earnings.
I go type in stock market catalyst into Google. I like Market Watch. There are a million others out there that show you what's happening. And like for instance, I know Wednesday it's gonna be a hot zone. We got CPI, inflation. That's huge right now because everyone's trying to figure out what the Fed's gonna do. Are they gonna hike it? Well, not hike. Are they gonna keep interest rates high, or are they gonna lower interest rates? If CPI comes in hot, the forecast is 3.4%. If it comes in at 3.6 and 3.7, market's going to drop because the Fed's going to keep interest rates higher for longer, right? That's why the jobs report was really good. Really good jobs data is bad for the stock market because now the Fed can keep rates higher for longer because their second mandate outside of inflation is to keep unemployment relatively low. And if there were more jobs reported, that means they're doing well on unemployment, which means they can keep rates higher for longer. So the next thing that people are going to be looking for this Wednesday on the 12th, right? I'm going to be very wary of my positions on the 12th, specifically that Walmart position if I'm still in it, is CPI. CPI is going to come in effect unless it comes in right at the forecast. If it comes in right at the forecast, there's probably not going to be that much market movement. If it comes in lower than the forecast, the market's going to go up. If it comes in higher than the forecast, market's likely to go down, you know. So, and you got an FOMC interest rate decision on Wednesday too. So the Fed's going to announce whether or not it's going to keep rates the same or if it's going to lower them. And if it states in that interest rate decision that it's going to keep it the same, that's probably what everyone's expecting right now. It might not have that great of that great of an impact, but I know what will have a great impact when the Fed chair speaks 30 minutes later and gives people a sense of whether interest rates are going to be cut before the end of the year or not. And if he says, "Oh, I don't think they're going to be cut," and maybe there's no interest rate cuts coming before the end of this year, market's going to tank. So, for specifically for this week, I would be very wary trading before Wednesday. Like I would probably, if I like that Walmart trade, if it's profitable over Monday and Tuesday, I would probably try to take at least some profit off the table on Tuesday if I'm up and then hold a smaller position going into Wednesday. Or if it goes nowhere going into Wednesday, I'll probably just cut it and then wait to enter another swing until after Wednesday. Just because I know that this is going to be a big day for the market, given that we got inflation numbers, an FOMC decision, and the actual Fed chair speaking 30 minutes after the fact. One of these events, if not all of them, are going to move the market on Wednesday. Right? Time-based exit, right? And then the last reason why I would exit a trade would be bad news. Was there some bad news reported that fundamentally changes how you view the position? Like that Disney leap that I'm in right now. What if they said tomorrow that they're closing all of their theme parks? I'm selling, right? I don't care what the stock price is. I'm selling. Um, if there's a big investigation, a federal investigation of Disney and its streaming services and it has to stop its streaming, I'm probably gonna sell, right? That's all I'm saying is like, and I'm just giving hypothetical situations, but if there's some extremely bad news that comes out that I know, like let's say Apple, uh, China and India ban the iPhone from being sold in China and India, I'm selling Apple, right? Not that I'm still in it, but if there's some extremely bad news, now there are lawsuits and things like that where you're like, okay, that's bad news, but I know lawsuits take 2 to 5 years, sometimes 10 years to resolve, and companies like an Apple or a Google that are always in lawsuits have billions of dollars to pay off any settlements, right? That's not going to affect their bottom line that much, but if they say something like Google's going to have to stop using its search engine or stop charging people for ads, right? Something that fundamentally changes the business, I'm out. You know, if Taiwan gets invaded by China and I own Nvidia or Taiwan Semiconductor, I'm out, right? Even though that's a great company, those are two great companies. If there's a war that's going to affect whether or not TSM can produce chips, I'm out. I don't care what my position is, whether it's a long-term investment, whether it's a trade, I'm out. You know, that's going to fundamentally change how I view that company. So bad news, extremely bad news is the fifth reason why I might exit a trade or my position. Right? So those are the top 5 reasons to exit a trade. Thesis, your thesis, number 1 is no longer correct. Number 2, you hit your percentage loss. Number 3, you hit your targets, which is a great reason to exit a trade. Number 4, it's time-based because you know earnings is coming up, a dividend date, FOMC interest rate decision. And number 5, really bad news that fundamentally changes your outlook on that stock, ETF, or instrument that you're trading. All right, family, that's it. That's it for this week. Same time next week. Mokama Sunday service. Like, subscribe to the channel.
Great, great, Peace.
Peace.